Hello, everyone. Welcome to our 4th edition of our COVID-19 Power Lunch, our twice-weekly video series that brings our professionals straight to you to discuss new developments and new legislation related to the coronavirus pandemic. On the menu today is frequently asked questions on investing during these uncertain times. With me today is Mike Carignan, Financial Planning Consultant with HKFS, and Kevin Golden, Senior Manager at James Moore & Company. Mike, I know that you've gotten a lot of questions from clients lately, and probably one of the most pressing ones is, what are some immediate actions I can take in this environment?
Absolutely, Erin, and thanks. That's a great question. I've had it several times, and there are a few immediate things that can happen. Many clients are concerned that, hey, if I take any action right now, I may be causing more harm than good by making changes while the markets are very turbulent. But a couple of the things that we are advising clients to do at this period of time, the first is actually a pretty minor change, which is do a rebalancing, which is if you set an allocation in the past, most likely because of the changes to the values of your bond holdings versus your stock holdings, they've gotten a little bit out of whack over the last 2 months. And for many clients, they will see a very good reaction on the recovery if they just do a rebalance now. And if you think about it, it does make sense logically, which is the more conservative sides of your portfolio are probably at a higher value now than those that are what we consider to be the riskier assets. But those riskier assets are the ones that are going to recover more when we start seeing the economy come back. As a result, simply selling the things that have done really well to buy into some that have actually been depressed a little bit right now will allow you to get a little bit of a marginal better return on the way back up, and maybe a little bit more, 1 or 2% more in the recovery than you might have gotten by simply holding on to everything you have. So we're not talking about changing your overall level of risk, simply fine-tuning it now that the markets have given you that ability. And at the same time that you're doing that rebalancing, for many clients, they're looking at taxable accounts. And taxable accounts give you another opportunity to do something called tax loss harvesting. So one of the things that I heard, I've been doing this for 20 plus years, and I've heard many, many times is, if you don't sell things when they're down, then you're never going to lock in a loss. But when you start adding in taxes into the equation of why might you do this, and you start considering why would you want to sell something at a loss, it's, well, sell it at a loss, go ahead and reinvest it in your portfolio into something similar, but now you have that loss so that Kevin can help you with your tax situation this year and potentially in future years as well. Kevin, can you tell them a little bit about what a tax loss could potentially mean, both on an annual basis and when it comes to things like capital loss carry forward?
Sure. Yeah. No, thanks, Mike. So as Mike mentioned, when you trigger those losses, right, a lot of times those are stock losses or those are capital losses, right? And what that means is that's probably stock you've held for a while, and now that when you sell it, you created a loss. Now, your losses that you have for the year can offset all your gains you have for the year. So later when that market recovers, if you've got all of a sudden income and gains later on, those losses can help to offset those gains. Also, if you have any other sort of capital investments that would trigger any sort of gain, those losses can also be used to offset those gains. Beyond that, beyond any investment gains or capital gains, it can also use some of those losses to offset a little bit of current year tax up to an additional $3,000. But beyond that, those losses carry forward. You can use those in a future year, that whenever you eventually do sell and have those incur those gains, you can offset gains in that year or any other capital gains that you may have in a future year. So those losses will continue to carry forward. You may use a little bit of it as you go along, but then once you have enough capital gain, you can use the rest of those losses in the future, even if you don't use it right now.
Okay. The next question that I get quite frequently is that last one was just about after-tax accounts, so brokerage accounts. But Since many people have the majority of their savings in their 401k plans, I hear, what should I be doing with my 401k right now? What are some of the things that I can do? And there's really two things that I've been advising most clients to do in this period of time. One of them is the rebalancing, which I already mentioned, but for others, it's also changing the contribution allocation. And what that means is that if you have a moderate allocation, so let's call it 60% equities, 40% fixed income, and that's what you normally invest into, just rebalancing back to that is going to be one thing that's helpful. But the other is for new money that's going into the plan, for a lot of clients that have 10 plus years until retirement or more, what I'm telling them is, hey, for the new money that's going in, put it all in aggressive. Have it all going into equities, because right now that's where we see the biggest potential gain over the next couple of years, simply to get back to where we were in February of this year. So for a short period of time, what we're saying is hey, you're just going to get a lot better return if you put everything to equities versus having that good blend. Not talking about changing the overall allocation for all of the money in there, but just the new money. So basically you're buying things as they're on sale, hoping that they're going to come back over the next year or two. So for 401ks in particular, that's what I'm talking about doing.
Mike, no, thanks for all that. I do have one quick question based on what you said. You mentioned selling some of your investments at a loss and then maybe investing in similar items. What are similar investments?
Sure, great question. And I know what you're referring to here, which is what's something they call wash sales, which if you have a question about that, please get with Kevin or I to ask some additional questions. But what I mean by similar is you could, for example, sell a large cap mutual fund and buy something like an S&P 500 index fund, and they're not the exact same holding. But one of the things you do need to be careful of, and why I say similar as opposed to exact, is you couldn't, for example, sell Bank of America stock and then immediately buy back Bank of America stock and get that capital loss. There are some IRS rules that prohibit you from selling it just to get the loss and then immediately rebuying it. So you want to buy something similar, not the exact same thing. So great question. One of the next questions that I get quite a bit is it time to invest the available cash that I have sitting on the sidelines in the markets today? And I will tell you that this is a very case-by-case answer, but in general, it's going to come down to two things. One is I tell all of my clients, maintain cash reserves that are going to be required to pay bills, or if you're a business owner, keep your business running. So you have to sit down and go, okay, how much do I need in case of, and you're going to know what the in case of is. So how long? Typically, when I'm talking to individual clients or retirees, I'm saying keep 2 years of cash available, because we're starting to look at this as it's going to take probably 18 months to 2 years to fully recover from this recession that's as a result of the coronavirus and get us back to what we would consider to be normal. So maintaining cash reserves that are going to allow you to cover that 2-year period without having to sell any investments is important. And the second is, what are your expectations if you're investing the money into the markets right now? And the reason I always ask, what are your expectations is from where we are today, I'm going to go back a little bit and say, okay, what has happened so far? We saw a peak in the equity markets back in February. And then in less than a month, we saw them drop to the lows on March 15th. And since March 15th, we've actually seen about half of that drop come back already in the markets. And now this week, we're actually seeing some declines based on oil prices and some other things that are uncertain. So what I'm telling clients is expect volatility. If you put the money into the markets right now, are we buying at the absolute bottom? We don't know. We could be at the new bottom. We could go back to where we were on March 15th. But ultimately, where we are expecting to recover to is back to those February highs. And that's probably going to take anywhere between 18 and 24 months if this is going to behave like a normal recession. And if that's the case, I ask clients, are you comfortable with a 20% return over the next 18 to 24 months with the expectation that, you may see the money that you put in today decline another 15% before it recovers? So the one thing I'm telling all clients is understand and have those expectations in your mind so that you're not uncomfortable with it. And so you don't feel like you made a mistake if it goes down from here. If you're comfortable putting the money in, expecting that, hey, over the next 18 to 24 months, it's going to go from here back to where it was in February of this year. So I'm happy with that, let's call it 20% return. If you're happy with that, yes, it's a great time to be putting money into the markets. But if you're not going to want to have some kind of volatility in there, not being willing to write it down another 15% to get back there, it is not a good time to be putting money into the market. So it's all about your expectations and your risk tolerance right now. So it's very important to understand what are you willing to have happen with that money. And for anybody that says they may have a need for that money, I am telling them keep it in cash right now. The markets are way too volatile, both on the bond and the stock side, to put any money that you need in that next year or two into any market at this point. So the next question I get quite frequently is, okay, we've heard a lot about what the government is doing. And I know James Morris put out a lot of information about what's going into the CARES Act, but in particular to what does it mean for people that have retirement plans if you're a business owner, or for individuals that have money in retirement plans and are having to take money out of it at this time? What are the different things that are going on? So I'm just going to cover 3 really quick ones. The first is charitable contributions. A lot of my clients have been using required minimum distributions to make charitable contributions. And this year, this is actually the second point, which is you can now defer your required minimum distributions. They are not required this year. So there technically isn't going to be a required minimum distribution for you to give to charity. But the CARES Act does allow you to give some of that money from your IRA and have a beneficial treatment for that. I'm not going to go into the specifics behind that. Kevin knows some more information on that, but we could do a whole webinar just on those provisions. So if that's something you want some more information on, please reach out to us, but we're not going to go into a lot of the details on that. There are also some provisions for making charitable contributions from after-tax accounts. They have relaxed some of those provisions up to 100% of AGI this year, where they were at 60% last year. And for defined benefit plans, there have been some specific things that they've done to allow delayed funding to those plans and also delayed withdrawals from those plans. So ultimately what it comes down to is, unless you need to take money out of a retirement plan this year for spending, they have put rules in place that are most likely going to allow you to push that off. So you're not going to be required to take money out in 2020. And that is a big benefit to allow people to have those accounts recover back to their previous values before they have to start taking money out of them or being forced to take money out of them. But taking that into account and taking into an account that one of the main things that the CARES Act is put in place for is that the government understands that for many people, they're seeing drastically reduced incomes this year because of the closure that's been required for the social distancing requirements. What that has also allowed us to look at is potentially doing Roth conversions where it makes sense for individual clients. Now, what's the difference between a Roth and a traditional IRA? Well, a Roth IRA, any growth from here going forward isn't going to be taxable. Traditional IRAs, if you put money into a traditional IRA or a 401k, you got the tax benefit in the past when your income was very high. If you have a very low income this year as a result of what's going on, it may make sense to go ahead and say, hey, I'm going to pull some money out of this traditional IRA or this old 401k that I have, and I'm going to convert it to a Roth. I'm going to pay the income taxes this year because I'm in a much lower income tax bracket. And now all of that money is going to be able to grow tax-free into the future. So Kevin, a little bit more on the tax implications that you want to talk about there?
Yeah, no, Mike, thanks. So like Mike mentioned, you know, it may be a great opportunity to do so. There could be several reasons as why you have lesser income in this year that makes that feasible. The obvious being the less income because people are staying at home in the social distancing and they're not able to work right now. It could be because some of those losses that we talked about, you know, that maybe you don't have as much income pushing you to a higher bracket because of that. It could be if you're a business owner that may be hit by this, or a newer business owner that is seeing a steadily decline and not going to see as much income from their business this year. A lot of different reasons that you might have lower income. That just makes sense. Obviously, whenever that conversion happens, that Roth conversion happens, that's that year in which all of that income, all of that growth and everything up to that point is going to hit. Some other things to think about, though, is cash flow, right? When that happens, you want to be able to have enough cash flow to be able to pay for those taxes somehow, right? And we can help you out, definitely myself, many of the other tax professionals here, James Moore, help you out with, well, what does that mean for my quarterly estimated payments I'm used to making? How is that going to change, whether it be that I'm not taking an RMD or I'm making this Roth conversion? It has not only tax impacts, but cash flow impacts to be aware of, but definitely something worth looking into to see if it makes sense for you, and seeing what other provisions may exist because of the CARES Act that just make this make more sense in this atypical type of year.
Okay. And the final question that I get the most often right now, and everything that we've talked to up to this point are details that may be important in your situation, and there's some detail work that we can potentially be doing. But the single biggest question I get is, how is this going to affect me long term? You know, what does my future look like as a result of everything that's going on today? And the biggest thing that I would tell you is that for all of you out there that have done a long-term plan, that have done a long-term financial plan, take a look at your long-term financial plan and make sure that it's up to date. You know, make sure that the assumptions that you made in that plan are still accurate. And if you haven't done one, I very strongly recommend that you sit down and you do a long-term financial plan. That is something that we do with our clients all the time. And I will tell you that without any equivocation at all, the clients that have a plan in place and that understand what the future is supposed to look like as in accordance with that plan are much more comfortable right now, because everything that we're talking about doing is in relation to that plan. And I would tell you that for most of our clients, we've been having these conversations for the last couple of years, which is there's a recession coming. This feels a whole lot worse because it has an additional healthcare component to it. But I will tell you that we plan for these times when we're doing financial plans for our clients. And as a result, most of them are very comfortable right now because they understand we have already designed their portfolios for something like this to happen. So if you haven't had a chance to review your long-term plan, please take the time to do that. And if you haven't had a chance to do an actual long-term plan, please reach out to us. You know, you can reach out to Kevin, to myself, to Aaron, and we'd be happy to help you take a look at your situation, your personal situation, and see, you know, do you have all of those individual things already taken care of, or are there some things that you could be doing during this period of time that would be helpful for your long-term plan?
Thanks, Mike and Kevin, for all your conversation and advice that you provided during this time. One of the things I definitely want to reiterate is how important planning is, and that along with HKFS, James Moore offers the GPS, which is our guidance planning system that helps clients kind of navigate through what their immediate plans are and long-term plans related to anything going on in their life. And I know it definitely can help provide comfort. So if you have any questions, please contact us about that. I also want to remind you that we do this series every Tuesday and Friday, whatever the latest topic is, or what clients are really asking about. So if you have any suggestions or things that you want to hear about, please let us know. And during those airings, we are available for live chat to answer your questions. But as always, please reach out to us with any questions that you might have, and visit our website, jmco.com, under the COVID-19 Resource Center for all the past weekly video series, as well as a lot of different articles and information. Thanks and have a great week.